Good morning, students. My name is Marlies Els. I'll be presenting class for you today. Can I just do a quick check whether you are able to hear me? If you can just in the Q&A for the students that know where to post questions in the Q&A, if you can maybe just pop a question in the Q&A to let me know whether I'm audible, then we can continue. Thank you. Okay, thank you. I received confirmation that I'm audible, so I will continue. Thank you very much. Like I said, my name is Marlies Els. I will be your presenter today. Might I just ask if there are maybe any issues during class? So if my sound for some reason disappears during class, maybe just let me know on the Telegram group, because while I'm presenting class, I can't necessarily see the Q&A. So please let me then just know on the Telegram group whether there are any sound issues, and we can correct them in time. Thank you very much. So today's class will be on property, plants and equipment. That is your lesson tool 5 in your study material. I just want to say that we will not be able to cover all of the content of PPE specifically. I just want to focus on one or two things. There are some pre-recorded videos already uploaded on your module site that you can also refer to for some more clarity. And this topic has already been done in first year as well, so you should have some base knowledge coming over from first year. Then just the next important thing, how can you contact us? We are receiving emails from students, so you are welcome to send us an email on the module mailbox. I just want to ask again, I know I asked in the first class, try to always use the module mailbox. And I'll explain the reason why again, because it does happen if you send an email to a lecturer specifically to their direct email address, and it happens that they are on leave maybe, or they are sick, they're not at work, they cannot attend to their emails, your email will remain unanswered until they come back. Whereas on the module mailbox, all of the lecturers that are on the module, that work on the module, has access to that mailbox, and there's always a lecturer appointed to a day or to a week that must attend to the emails and the student queries. So if you send your email to the module mailbox, you are guaranteed that your query will be attended to. Whereas if you send it to a lecturer's direct email address, it might happen that your email will not be attended to for weeks, depending on how long they are on leave or how long they are away. So please always try to make use of the module mailbox. Then your second option is to contact us via the discussion forum. All students should now be allocated an e-tutor. So you should have two module sites. You should have your main module site, which is the one that the lecturers are responsible for, and then you will have an e-tutor site. So on both of your sites, you should be able to post questions within a discussion forum. Within the discussion forum, the lecturers will attend to the questions, and students can also assist each other and answer each other's questions. So there you can also, within your student community, assist each other and help and answer questions for one another. And then for this class, you are welcome to post any questions in the Q&A section. Please just limit it to questions relating to property, plant and equipment. At this stage, if you've got any admin questions, or if you've got any other questions relating to any other of the lesson tools or topics, please then send those questions to the module mailbox or to the discussion forum. For the students that do not know how the Q&A works, I've just added these screenshots again. So you will see that you should have, if I can look at the first one, there is next to your live event, there's that Q&A box. If you click on that, you will have the option to ask a question. So click in the second screen, you will see there's an ask a question, and then you can type in your question and post it, and then I will try and go through some of those questions during the class or after class. So if you've got any questions relating to PPE, please feel free to post them there. I will try to attend to some of them in class, or if I can't get to them, I will post answers after class. If we then go to PPE, what are we dealing with and what is IAS 16 or PPE all about? So in the first class, I explained to you that in accounting, we work with guidelines or a set of rules that will assist us on how to treat transactions and specific areas within accounting. And in PPE, we have IAS 16 that deals specifically with PPE to tell us how we should recognize and measure when we buy an asset. We need to first of all determine, can this be classified as a PPE item? Is it maybe inventory? Is it investment property? And it will give us then a certain set of rules or guidelines to say, how do we determine whether this is PPE? So if we look at an overview of what IAS 16 deals with, first of all, it deals with recognition, and we will go through some of this in the class today. So first of all, recognition. So the first question, can I recognize whatever I bought, this item or this expense I incurred, can I recognize it as an asset, and then is it a PPE asset? If it then is, does it meet all of the different requirements? Then I can continue. Then the second thing we look at is initial measurement. So I've now determined that this can be classified as a PPE item. So I must recognize it in my financial records. But then at what amount can I recognize it at? And there, once again, IAS 16 will give us some guidance on how can I then calculate the cost of this item initially. It's important to determine that there are initial costs and there's then also subsequent measurements. We will first look at the initial measurement. So the first time I will recognize this asset, at what amount can I recognize this asset? And if you look at the figure or the graph that's given there, you will see that my initial cost consists of a purchase price. So the amount I've paid, how can I determine on transaction date I've paid for this, what is included in the cost of my asset? How do I calculate the purchase price and what determines my purchase price? I've also got directly attributable costs. So there's other costs involved in this transaction. Can I capitalize this cost to the cost of the asset, or must it be expensed? Once again, IAS 16 will give us guidance on all of this. And then it also gives us some guidance on there are some possible future costs involved or expenses that I must incur in the future that relates to this asset. Then how do I treat this? Can this form part of the cost of the asset, or once again, must it then be expensed on the day that I actually incur these costs? IAS 16 will give us guidance on all of this, and we will have a quick look at all of these different aspects. Then the next thing is subsequent measurements. So I've initially measured, and then at later dates, something happened. It can happen that I incur additional costs. Let's just look at that one, subsequent cost there. My apologies. So that is the one that we're looking at now. So that is later on, I incur some expenses. It might be like you can see there, I need to service this asset. It's a regular service, or it might be a major service. There are differences between the two. I need to replace parts. It is possible that parts have different useful lives. So the one part of an asset has useful life of 10 years, another part has useful life of 5 years. How do we deal with that? So after I've initially determined the cost of my asset, it is possible that at a later date, I will incur costs again on this asset. And then IAS 16 will tell us, how do we treat those costs? We will also look at that. Then the third thing is now subsequent measurement. Subsequent measurement, so at year end, I need to calculate depreciation on this asset. What are the methods I can use? And then how do I calculate? Then you will also see the impairment loss. Impairment loss is just take note of that. That is another costs relating to assets, but that will be dealt with on third year. So keep in mind that when we are dealing with IAS 16 or PPE, that in future we will have to determine also an impairment loss. But for second year, at this stage, it is not relevant. Then you'll see that we also have derecognition. So when can I derecognize? What is derecognition, and when can I derecognize an asset? What are the requirements for that? And then lastly, also very, very important, presentation and disclosure. So I've now gone through all of the steps. IAS 16 has said to me, how do I treat my transaction? How do I bring it into my financial records? Then when it is in my financial records, during the use of the asset, how do I treat various aspects of this asset? And then it also says to me lastly, but at the end of the year, now I need to show all of my investors or creditors, whoever uses my financial statements, I need to show them the information relating to PPE. So what do I need to show them, and what does it need to look like? Presentation and disclosure is always also very important, because once again, as actually with everything, it must be done according to the rules of IAS 16. So if we ask you to provide disclosure at the end of the year, or in an assessment, we ask you to give us the disclosure, but your disclosure is not according to the requirements of IAS 16, that actually means that your answer is wrong. So that will have an impact on the grade you get at the end of your assessment. So it's very important, and I've said this in the first class that I presented as well, you need to know and understand all of these guidelines. You need to understand why things are being done the way they are being done. I have noticed on Telegram, that students are asking relating to inventory. But why, and I must say that at this stage, I've not gone to look at the different examples, because as I explained to you in the first class, I'm not actually, directly involved in the teaching of the module. So I've not gone and looked at those examples. But students are asking why in this example they did things in this way, but in another example they did things in another way. And it might come down to, what does IAS 2 say relating to inventory? There might be something different in that question, why an expense is dealt with in a certain way in one example, but in another way in another example. And it can be the same for IAS 16 as well. You can get different costs, but in one scenario, it is dealt with in one way. In another scenario, it is dealt with another way. And that might just be something within the question where we changed just your given information in a question to test whether you know the different rules and the different implications of when things happen. So it's very important that you understand and you know these guidelines or rules for each one of your transactions or topics within FAC2601. So that was just our overview. And like I said, the first thing we're going to look at is our recognition. So what does recognition tell us? It tells us when can we recognize an expense as PPE. So then IAS 16 tells us we can recognize something as PPE when it meets the definition and the recognition criteria according to IAS 16. So what is a definition? IAS 16 tells us that the definition of PPE, it is a tangible asset used in the production or supply of goods, used to rent out to third parties or for our own administrative purposes. And also very important, expected to use for more than 1 year, so longer than 12 months. Okay, PPE are non-current assets. So if something is used for less than 12 months, we cannot classify it as PPE. So important at the period, we must be using it for longer than 12 months. Another important thing to also remember, and this is for future in your third year, this distinction will come in. PPE is a tangible item. So what does tangible mean? It means it's a physical item. It's something that I can touch, I can feel, I can see. Because when you get to third year, you are going to start, they're going to introduce intangible assets to you, and then you would need to be able to determine the difference between if something is PPE and if it is an intangible asset. So just remember, PPE is a physical asset. It's a physical item. It's tangible. It is used in the production or supply of my goods, or it can be for my own administrative purposes. So, for instance, I've got an office block that I use for all of my personnel to sit and work at. That is for my own administrative purposes. And then thirdly, we expect to use it for more than 12 months. So once you meet those three criteria, it means you meet the definition criteria of PPE. But remember, when we said here, we've got two criteria. We need to meet the definition first. If we meet the definition, then we can go to, okay, but do we meet the recognition criteria? So we've determined we meet the definition criteria. Now we need to look at what are the recognition criteria. So recognition criteria is, first of all, it must be probable that we will have an inflow of economic benefits. So whatever asset we purchase, this asset must generate economic benefits for us in the future. Okay, these benefits can be direct or indirect. In other words, it can directly lead to revenue. So I use this, I purchased machinery. This machinery will be used to manufacture a product that we will sell. So that means the machine directly leads to revenue that we will get in the future because we're making products that we will sell in the future. But then it can also have an indirect economic benefit, meaning that we will save costs later on. So how that can be is then we're buying a newer machine that can maybe produce more products in a shorter space of time. So that means that we can get more products out, or that might require less materials. So that means we save costs on materials in the future, and that is then an indirect method of leading to economic benefits. So remember that the first requirement, it must lead to economic benefits, but it can be direct or it can be indirect. And then the second requirement is that the cost must be measured reliably. So if I buy the asset, I must be able to determine the purchase price and the cost of the price or the expense of all of the other directly attributable costs relating to that asset. So I must be able, it should not be that someone says this might be the price of the asset. I buy the machine, they tell me that the machine is 1 million rand, and then the cost to get the asset to my property will be an additional 50,000. So I know that the cost of the machine is 1,050,000. I can measure that. That means I now meet the two recognition criteria. I've already determined I meet the definition of an PPE asset. I've determined I meet the recognition criteria, and the date that I meet these two, I can now say, okay, but then I can go and I can recognize this asset as PPE. So just to recap quickly, to be able to recognize a cost or an expense as PPE, I must meet the definition and I must meet the recognition criteria. If I do both, I can say, okay, this is a PPE asset, and then we can continue on to say, okay, but now we need to determine at what price will we recognize this asset. Like we said earlier in that overview, the cost of an asset consists of three things. We have the purchase price, which is the price that I pay for my asset. I've got the directly attributable costs. So those are the extra costs that I incur to get it to purchase this asset and to be able to use that asset in the way that management wants it to be used. It can be that you ship it from overseas, you buy this directly from an overseas supplier, you need to pay the shipping costs. There might be installation fees that is required to get the machine or whatever asset you are using. So there might be installation costs. So there you need to know, but it's also possible that there are costs that you incur, but it is not directly attributable. So for instance, you need to train some staff to be able to use the machine. Those costs we cannot capitalize to the cost of the asset because those costs are not necessary for the machine to work in the way and in the location that management wants it to work. So we look at directly attributable costs, and then lastly, there might be some future costs. We will look at these three differently, but if we look at future costs, it might be that I own a piece of land. I'm going to mine on this piece of land, but then there are requirements for me that at the end of the mining period, so when everything has been taken out of the ground, I need to restore that piece of land to what it was initially. So for me, in order to mine whatever is within the ground, if it's gold, platinum, it doesn't matter what, I need to remove all of the trees. It might be that I need to move some water, for instance, and then there's a requirement. But after you are done, that piece of property must look the way it looked before you started with your mining operations. So that would require me to do some ground restoration, to plant trees again. So even at the date that I purchase this asset, I know that in the future I will have to incur some costs, and that it might be possible that we would be required to indicate that in the cost of that PPE item already at initial recognition or initial measurement. So in some instances, it might be that we recognize it at a later date, but we need to look at what does the requirements of IAS 16 say. When do we recognize it as part of the initial measurement, and when will it be a subsequent measurement? So if we look at the purchase price, how do I determine my purchase price? So my purchase price will be influenced by the way that I purchase that asset. So there's, according to IAS 16, there's three ways that we can obtain an asset. The first is that we have a cash purchase, so that's possible. It's just cash. You give me an asset, I pay over the money immediately. A cash purchase can also be on a credit basis, but it's the exchange of money. So a cash basis. The second one is the exchange of assets. So with the exchange of assets, I've got one asset, you've got another asset. We want to swap the assets. So how do we treat that? How do we determine the cost of my asset when we just exchange assets? So that's not a cash transaction. It's not that we pay money for it. We just exchange different assets. That we will have a look at. And then the third one is by way of government grants. So just be aware of that. We do not teach that in this module. So the way in which I obtain my asset, it will have an influence on the purchase price of my asset. So it can be a cash transaction where we swap cash. It can be the exchange of different assets, and then it can be by way of government grant. So let's first look at the exchange of assets. IAS 16 always wants you to use the fair value of the asset given up. So if you can look at my picture there, we swap two different trucks. You've got one truck, I've got another truck. We want to swap. Or I've got an ambulance, you've got a truck, or I've got a truck, you've got a ship, doesn't matter. We want to swap. I want to give you the one, you want to give me the other one. IAS 16 says that we start off with using the fair value of the asset given up. So if I've got both, I've got the fair value of the asset given up, we can use that. But then IAS 16 says, unless the fair value of the asset given up is not available. So the fair value of the asset given up is the asset that I am giving away. So I've got, let's say, I've got a, doesn't have to make sense, but let's say I've got a tractor and you've got a boat. We want to swap. So I'm giving you my tractor, you're giving me the boat. So in this scenario, we have the fair values of both of these assets. Then IAS 16 says, since we've got the fair value of the truck, or the tractor, my apologies, we're going to use the fair value of the tractor to recognize the boat at. We've got that available. But then IAS 16 says, if the fair value of the tractor is not available, then we're going to use the fair value of the boat. So we've got, I'm swapping my tractor with your boat, but now we say I don't have, or I cannot determine the fair value of the tractor. So then we're going to use the fair value of the boat to recognize the boat in my financial records. But then IAS 16 also says, if no fair value is available, or if the transaction does not have commercial substance, then we use the carrying amount of the asset given up. So if we don't have the fair value of the tractor, we don't have the fair value of the boat, then we're going to use the carrying amount of the tractor to recognize the boat. Or if the transaction does not have commercial substance, then we will also have to, my apologies, I'm going too fast. Then we will also have to use the carrying amount of the tractor that I'm giving up. So what does it mean when does a transaction lack commercial substance? Once again, IAS 16 gives us some guidance on this. So when does an asset lack commercial, when does an exchange transaction lack commercial substance? The exchange will not change the future cash flows in any way, meaning that there's no change in the risk, the timing, or the amount of the transactions. So I've got a blue car, you've got a pink car, it's more or less the same age, it's got the same amount of kilometers on it. You just like the one color, I like the other color, we decide to swap cars. That means that it does not change the future cash flows. It's literally just a different color car. That means there's no commercial substance in that transaction. Secondly, if it does not change the value of the operation that is to use the asset, it does not have commercial substance. And then thirdly, if any expected change in the cash flow is insignificant relative to the fair value of the asset. So if I exchange an asset with a value of 2 million Rand, but it will lead only to a 1,000 Rand difference in my cash flow, that is not really a significant change in relation to the fair value of the asset. Then that is also an indication that this transaction does not have commercial substance. So there are 3 things that IAS 16 says to look out for when we determine commercial substance. If the transaction does not change my future cash flows, that means that there's no change in the risk, the timing, or the amount of the transactions. It's an indication of that there is no change in commercial substance. It will not change the value of the operation. And then thirdly, the expected change in the cash flows is insignificant relative to the fair value of that asset exchange. If any of these 3 are there, that means that my transaction lacks commercial substance. If that happens, then IAS 16 says, if I've got no commercial substance, I cannot use the fair value to determine the cost of my new asset. So just remember again, what are we busy doing? We need to determine, we are exchanging assets. So the asset I'm giving away or exchanging, I'm going to de-recognize from my financial records. But I need to now recognize the new asset that I'm getting. I need to recognize that asset at my in my financial records. But now, since I'm not actually paying a cash value, or I'm not giving the person I'm buying from or exchanging, I'm not giving them cash. I need to find a way to determine what will be the cost of this asset. So I'm getting this asset, but at what value or what cost will I recognize it in my financial records? Because I can't not recognize the transaction. I need to show the users of my financial statements. But during this year, I've de-recognized one of my assets because I'm not using that asset anymore, but I've got a new one. But I need to determine the value at which that new asset will be recognized in my financial records. I'm not paying cash for it, so I need to find another way to determine the purchase price of this asset. So IAS 16 says, just to sum up again, I determine, are the fair values available? Yes, fair values are available. Okay. Do I have the fair value of the asset I'm giving up? Yes, I do. Then I use that value to recognize my new asset at. If I only have the fair value of the asset I'm receiving, not the one I'm giving up, then I will use that value. If none of the fair values are available, Or if I don't have commercial substance, there's no commercial substance in this transaction, I'm going to use the carrying amount of the asset that I'm giving up. Okay, so you ask yourself these three questions. Do I have commercial substance? Yes, I do. If I've got commercial substance, then I can use my fair values. Then I have a look at, is the fair value of the asset I'm giving up available? If it is available, yes, then I use that value to recognize the new asset. If my answer is no, the fair value of that new asset or the asset I'm giving up is not available, I've got the fair value of the new one, then yes, I'm using the fair value of the asset that I am receiving. If I don't have commercial substance or there's no fair values, I'm using the carrying amount of the asset given up. That you will have because you will have the information in your question to be able to calculate that value. Okay, so that is with the exchange of assets. So just remember, fair values, are they available and does it have commercial substance? Your question should have enough information to guide you to make the determination whether there is commercial substance or not. If we look at then an example of the exchange of assets, so the question says to us, let me just get a highlighter quickly. So the question says, I have an ambulance AB1 with an original cost price of 1 million and an expected useful life of 10 years. This ambulance was exchanged for a newer ambulance. So this should already guide you a little bit. A newer ambulance. The exchange took place on 1 April 2024. And the question is now very specific. It is making it easier for you. The transaction does not lack commercial substance. So there I already know if my fair values are available, I can use fair values. Then the question says, on this date, the following information is available. So relating to AB1, they give us the fair value. They don't give us the carrying amount because your question should normally give you enough information for you to be able to calculate the carrying amount yourself if it is then required. It also relating to AB2, it gives you the fair value and it gives you the carrying amount. So now the question asks you, what will be the amount that the ambulance 2 will be recognized at in our financial records? So what will the value be? So remember, the first thing we said is, do we have commercial substance? Yes, we do. Why do I say that? Because the question tells me specifically the transaction does not lack commercial substance. So then the second question is the fair value available? So what is the preferred fair value we need? The fair value of the asset given up. What asset am I giving up? I am giving up ambulance number 1. Do I have the fair value of ambulance number 1? Yes, I do. So that means that in my financial records, I will have 400,000 Rand as an addition for my ambulance. And that will be ambulance number 2, because this is the one we're getting. Remember, we are de-recognizing ambulance number 1. But what value will we de-recognize it? Carrying amount on the date of de-recognition. So your question should be able to give you enough information to determine carrying amount on the date of de-recognition. I will de-recognize ambulance 1. I will have as an addition ambulance number 2, and I will have that at 400,000 Rand. Okay, I know it seems like a lot, but it is actually very easy. Just check for commercial substance, check if my fair values are available. And that is the exchange of assets. If we look at the purchase price, remember I said there's 3 ways in we can purchase. It can be by way of a cash transaction, the exchange of assets, and then government grants. So we've now dealt with the exchange of assets. Let's now look at when I do a cash transaction. So where I'm going to pay my supplier. I don't necessarily pay him immediately. I might pay him in 2 months or 3 months. That means I might have a creditor for a little while, but it is still seen as a cash transaction. And in this case, the purchase price will be determined based on the cash price equivalent. So what will the cash price equivalent be on transaction date? Why do I say that? It's important to make a distinction between normal credit terms and abnormal credit terms. It might be, so remember I said I can actually pay my supplier on transaction date. So on 1 January, I buy an asset from someone. I can pay them on 1 January, or I can even pay them before transaction date. But I can also pay them, they've got uh, normal credit terms where they say, okay, all of my customers can pay me after 30 days. So then we pay them at the end of January. That's normal credit terms. It is also possible that a supplier says, okay, you can pay me over 3 months. So then we pay him a portion at the end of January, portion at the end of February, portion at the end of March. It is still normal credit terms. In this case, I use the cash price equivalent of the amount that I'm actually paying. What does that mean? I need to pay 100,000 Rand for this asset. Cash price equivalent is the cash payment of 100,000 Rand. But in the event that I'm paying this supply of mine at a later date, so I buy this asset on 1 January. Normally, the creditor says, okay, you need to pay me after 30 days. At the end of January, I expect payment to be made. But we make a special arrangement with the supplier to say, for whatever reason, can I pay you after 6 months? And we make a special arrangement. So now we are not within the normal credit terms of that supplier anymore. We're dealing with abnormal credit terms. Then IAS 16 tells us, but now we can't use that 100,000 anymore, because the value of 100,000 Rand today is different than the value of 100,000 Rand in 6 months. And we need to account for what they tell us is a time value of money. So things get more expensive. You know, if you think of what does a can of Coke cost today versus what it cost last year, the value is not the same anymore. The same happens with cash value. Over time, the value of cash will change. So what I can buy for 100,000 Rand today is not necessarily the same what I can buy for 100,000 in 6 months. So we need to account for that time value of money. This is, and just remember, we do this when we are dealing with things beyond normal credit terms. So if a creditor normally says you can pay me after 3 months, it's fine. We use that cash payment as our purchase price. But when you can see from a question or from a transaction that I'm making special arrangements, this is not what the supplier normally does, then we would be required to calculate the present value for the future cash payments. So if we look at an example of this, so our example says to us, A Limited purchased a machine on 1 January 2025 for an amount of 100,000 Rand. So we purchased this machine 1 January 2025 for 100,000 Rand. The amount is payable on 30 June 2025. It is the normal credit terms of B Limited for all invoices to be paid 30 days, or that should be transaction date. My apologies, not payment date. So 30 days. So like we said previously, on 30 January, this invoice has to be paid. But we've now made a special arrangement with B Limited to only pay them on 30 June. So can you see from this example that we are dealing with abnormal credit terms? The question gives us sufficient information to determine, but this is not what B Limited would normally do. They have given us a special arrangement to only pay them on 30 June. The question then also says you're always going to need an interest rate. So the pre-tax discount rate that is relevant here is 12% per year. Then the example asks us to calculate the purchase price of the machine. Let me just get to the pen again quickly, then we can do this. Okay. So I don't know how many of you have done PV calculations before. If you've not done them before, you will need, and this is where your financial calculator comes in for PV calculations, and you'll also do this when you deal with leases. You need a financial calculator to input all of this information and then be able to calculate your present value. So first of all, when you work with financial calculator, you need to tell the calculator, am I dealing with a period monthly? So Normally, will these payments be made monthly, or are they yearly, or they quarterly? So you need to set your financial calculator to determine, am I working with months? Am I working with years? Is it quarterly? What is my period? So in this case, because we're dealing with months, you will set your calculator to 12 payments per year. If you don't know how to do that, there are so many videos on YouTube on how your specific financial calculator works. I would suggest watching a lot of YouTube videos to see if you don't understand your manual. You should get a manual with your financial calculator. Otherwise, there are multitude of YouTube videos available that can help you with the different calculations. So first of all, make sure your calculator is set to 12 payments per year, because we are working with months, not years or quarters. So I've set my calculator to 12 payments per year. What then is my period? The M stands for the period that is relevant for this transaction. So we had to pay my creditor on the 1st of January, but we've actually made an arrangement to pay him on the 30th of June. So I need to determine what time will lapse from 1st January to 30 June. In this case, it is 6 months. So my period will be 6 months. The next thing I need to tell the financial calculator, what interest rate does it need to use to calculate my present value? So I've said to the calculator, you need to calculate a present value for a period of 6 months. So after 6 months, I need to pay 100,000. What will the value of that 100,000 rand be today? So then I need an interest rate. My interest rate given to me is 12% per year. And then the next thing is, but actually, what is the value that I need the present value for? So I've determined that on 30 June, I need to pay 100,000 Rand. What is the present value of that 100,000 on 1 January? So I tell it my future value will be 100,000. If I enter all of this into my financial calculator, I should get to a present value of 94,204.52, but then you can round that off. So that means my present value on 1 January is 94,000, and this will then be my purchase price. So the cost price will be, or the purchase price will be 94,205 Rand. It won't be the 100,000. The difference between the 100,000 and the 94 is 5,795 Rand. This amount will be recognized as interest for this period. So although I will be paying 100,000 at the end of the period, my purchase price will only be the 94,204 Rand, and the difference, that 5,795, I'll recognize that as inventory. So this is just purchase price. So remember, we dealt with the purchase price. Initially, we said the cost of an asset consists of the purchase price, directly attributable cost, and future cost. What we've discussed now with exchange of assets and with the abnormal credit terms is just to determine the purchase price. I still need to have a look at the directly attributable costs and then the possible future costs that I need to incur. But just relevant to my purchase price is, if I've got an exchange of assets, what will the purchase price be? Or if I've got a transaction that is beyond normal credit terms, what will my purchase price be? For all of this, I want to say, keep in mind when you are studying the different ways in which this can be asked to you. The easiest can actually be do disclosure, so give us your PPE note, but you can also be asked to do the journals. So journalize the purchase of this asset, or journalize all relevant transactions for the year relating to this asset. Then you're going to have to journalize the purchase of the asset, all of the costs that's involved. You're going to have to do depreciation and all of it. So keep in mind that you are able to answer all of these questions. And then thirdly, you can also be asked to answer a discussion question. So we can give you a certain scenario and we can ask you to discuss the recognition and measurement of the purchase of the machine. Then what I've now discussed with you, you will have to describe to us. So when we say discuss, you will have to say, okay, according to IAS 16, I can recognize an asset if it meets the definition and recognition criteria. The definition of an asset is X, Y, and Z. Then you need to apply. Then you need to say, is it a tangible asset? What does my question say? Okay, it is a machinery, therefore I know I can touch it, I can feel it, it is tangible, it meets that requirement. Will I be using it in my own production? What does the question say? So if the question says we're going to use this in the production process to manufacture shoes, yes, I sell shoes, I'm going to manufacture shoes, I will use this in my own production process. And then thirdly, will I use it for a period of longer than 12 months? The question should tell you the useful life of your asset. Then you can say useful life of the asset is 5 years, for instance. So yes, it is. I will use it for longer than 12 months. Therefore, it means I meet all of the definition criteria. I can now move on to recognition criteria. Will this asset lead to an inflow of economic benefits? Yes, it does, or no, it does not. And why do you say that? What information within your question gives you enough information to tell you that it will or will not lead to future inflow of economic benefits? And then lastly, can I measure the cost of this asset reliably? And then you can go, yes, I can, because the purchase price is given to me as 100,000 Rand. All of these are the directly attributable costs. Therefore, the cost can be measured, meaning I can recognize this as a PPE item. And then you can go on to the measurement. What does IAS 16 say about measurement? It says an asset is measured at the purchase price plus directly attributable costs plus possible future costs that I need to account for. And then you discuss all of those. But what is my purchase price? Then if there's maybe abnormal credit terms, you will have to discuss that. Then you will have to say, okay, but IAS 16 says if I've got abnormal credit terms, I need to recognize or measure this asset at the cash price equivalent on transaction date. And as I've discussed this now with you, you need to discuss it also in your question. So keep in mind, when you have to answer a discussion question, you will have to be very detailed. You will have to explain every decision that you make. So if you have to do calculations, you will basically have to explain every step of your calculation. But why are you using a period of 6 months? Why don't I use only 1 month? Why don't I use 5 months? Why do I use 6 months? Why do I use an interest rate of 12%? Why do I use a future value? Why do I, first of all, in any case, calculate the present value? Why is that necessary for me? And then the same when we go on to depreciation. Remember, depending on what a question asks you, if it only asks for initial measurement, you will discuss your purchase price, directly attributable cost, and you will discuss possible future cost. If it just says measurement, that means initial and subsequent measurement. So I know this is a lot of information, but this is the way you need to think when you study. How can they test this? I need to be able to answer all of these questions depending on how they test it. If they ask me to provide journal transactions, will I be able to show them all of the different journals depending on what? If it's a normal cash price, normal credit terms, can I give them the journal for that? If it is a transaction beyond normal credit terms, can I provide the journals for that? If I need to de-recognize an asset, can I do the journals for that? And the same with disclosure. Am I able to disclose all of it? Do I know which are the relevant disclosures that is applicable to PPE? All of that, and then discussion questions. I think discussion questions are probably the most difficult, and I can guarantee you that in your assessments and in your exams, you will get discussion questions. So you need to know how to answer those questions. So think of them as you study, that you are able to answer those questions. Okay, I've said a lot now, but I just want to prepare you to, as you work through your study material, that you study correctly to be able to answer the relevant questions when you get to an assessment. So we've dealt with purchase price now. The next thing, remember we said the cost of my asset consists of purchase price, directly attributable cost, and then future costs. So if we look at directly attributable costs, it's actually very easy. You just need to determine the following. Is this cost necessary to get the asset in the location and the condition necessary for use as intended by management? So like I said earlier, it is possible for you to incur some expenses. If I've got a piece of land, whether I want to use it for manufacturing, I want to put up a huge manufacturing operation there, then I must first need to do some site preparations. I must first clear the ground. I must level the ground. I must incur all of these costs even before I can start to build my manufacturing plant. There will be delivery fees that I need to pay for all of these assets to be delivered to my site. Installation costs. It might require some very skilled labor to set up or install whatever asset it is I'm purchasing. You have to determine and you have to think about, is this cost necessary? So I've incurred delivery fees. If I don't have the delivery fees and they don't deliver the asset to me, can I use this asset in the location and condition that I wanted? So I want it at my property in Pretoria. It is currently sitting in Durban in the harbour. I need to pay delivery fees to get it from Durban to me. If it's not delivered to me, can I use it? No, I can't, because then it's not in the location that I wanted. So therefore, delivery fees will be necessary for me to get the asset to my location and then to use it as management intends it to be used. Installation costs. I need, like I said, I need special labor or someone's special qualification to come and install this asset, whatever this asset is. I need someone to come and install it. I can't do it myself. I don't have the skills. I don't have the knowledge. So currently, it's possible that the asset is in my location, so it's sitting here, but it still needs to be installed. If I don't pay the installation costs, the asset will just sit there. I can't use it. So is that cost necessary then to get it into the condition necessary for me to use it as intended by management? Yes, it is. So therefore, that cost can be capitalized to the cost of the asset. Examples of costs that are not capitalized to the cost of the asset. Staff training. So I'm buying a new machine. The machine can operate fine. It's been installed. It's in my location. So the machine can operate. It's just that I need people to learn how to operate it. Staff training costs is not necessary because the machine can work. It's just that my people are not able to operate it. So therefore, staff costs will always be expensed because the machine has already been, it's been shipped, it's been delivered, it's been installed. That machine can work as management intends it to work. I just need to train my personnel. So staff training costs will be an expense. It will not be capitalized to the cost of the asset. Cost incurred while the asset is idle. So something happens, my people are on strike, so the machine is just sitting there. I've got, like we said previously, I manufacture shoes. Currently, my personnel are on strike, so the machine is sitting there. It was working. It's just not working now. We're not operating. The cost incurred for that period cannot be capitalized to the cost of the asset because the machine is available and ready for use. It's just not, for some other reason, with an operation issue within my company, the machine is not currently working. That cost will have to be expensed. I cannot capitalize that cost to the cost of my asset. So for each and every cost that you are given, it's possible in a scenario you can be given a variety, a list of costs that you incur. You can have legal fees, doesn't matter what costs are given to you. You need to then go back to these 4 requirements. Is it necessary to get the asset in the location, the condition necessary for use as intended by management? You measure your expense or your cost according to this, and then you need to determine, once again, if it's a discussion, you need to say, why are you saying this? Why can I argue that delivery fees can be capitalized to the cost of the asset? Because I need to incur these costs to get the machine or the asset to the location and condition I wanted for it to work within my business. Then if there's another cost, why do we come to the conclusion that it must be expensed, it cannot be capitalized? So for each and every cost that you are given, you need to be able to make this determination to say whether it should be included or not included in the cost of your asset. Then the third item or type of cost that can be part of the initial cost of my asset is future dismantling costs. So like I said earlier, it might be possible that the day that you purchase, it can be a property, it can be an asset. If I set up a manufacturing plant, before I get approval for this, they might say to me, it's fine, you can set up this plant, but once you're done, the day that you move, or once the asset is taken out of use, you need to dismantle this plant. There must be nothing of it left. Then you know that you will incur costs in the future, because it is going to cost you money to dismantle the plant. Or like I said, if I've got, for instance, I've got a land that I'm going to mine on, I will have to restore that property to the way that it was initially. So I will have some to restore. I will have to restore some of the site. There will be site restoration costs that I have to pay in future. Then we need to determine, do I have this obligation at acquisition date already? So on the day I get approval, I'm setting up this plant, I already know, but at the end of the 20-year useful life of this plant, I'm going to have to dismantle the plant. Therefore, on acquisition date, I already have an obligation. And that means that at acquisition date, I have to recognize the future dismantling costs. And that cost will be capitalized to the cost of my asset at initial recognition as part of my initial cost. How do I recognize that cost? How do I calculate that cost? We use the same principle that we did when we calculated the present value for the beyond normal credit terms. So you will be given information, you will know it will be a 20-year period. They will tell you that what the estimate is for the cost at the end of the 20-year period, and I need to calculate the present value for that cost, and that cost must be capitalized to the cost of my asset. If it's over time, we will capitalize it at subsequent costs. So if I use it as I use it, I get an obligation. So it's not at acquisition date. I don't know at acquisition date that I'm going to definitely have a obligation that I have to pay in the future. It will only be at a later stage as I use this asset. Then that cost, that dismantling cost or that site restoration cost will be treated as a subsequent cost later on. So if my obligation exists at acquisition, we have already said we're going to need to calculate the present value for it, because like we said with the abnormal credit terms, time value of money, the value of something today is not the same as the value of something in 5 years or 20 years. So I know that in 20 years, I'm going to have to spend 5 million Rand to restore this site or dismantle this plant. But it's going to cost me 5 million in 20 years. But the value of that 5 million in 20 years is not the same as the value today. So I need to calculate my present value for that 5 million today and recognize that. Yeah, I've just shown you an example of what your journal would look like. We've already dealt with the present value calculation. Like I said, it will be similar to what we did when we did the abnormal credit terms. The only difference will be that when we are doing this calculation, our calculator will be set to yearly payments or yearly periods, because we're not working in monthly increments anymore. We're now working with years, because I know in 5 years I need to pay. So therefore, I'm going to set my financial calculator to one payment per year, and then the period will be, that end period will be whatever the question says. So if the question says in 5 years, I've got this obligation, my N value will be 5. If the question says in 20 years, I'm going to have this obligation, my N value will be 20. The question will give you your interest rate that you will have to use, and it will also give you an estimate of what the cost in future will be. So the question will give you all of the information to be able to calculate the present value. You calculate your present value, and here I'm just showing you how you will in a journal recognize this cost. Because obviously you're going to have a cash payment today. You're going to have a cost that is you're paying. In this instance, we were purchasing machinery, for instance. So there's going to be a cash value that I'm paying for the machine, and there you will see. So I'm going to credit my bank with my cash value. So if it was 100,000 Rand, that is the actual cost of the machine, I will credit my bank with 100,000. The cost of my machinery will be 100,000. And then I will have calculated the present value. So let's say, for argument's sake, I have calculated a present value of 20,000 Rand. So that is my obligation. So that is the present value of whatever future dismantling cost or site restoration fees I'm going to have to pay. So I've calculated. So like I said, let's say for argument's sake, it's 25,000 Rand. I'm going to debit my future dismantling costs. This will also be an asset for 25,000. And then I'm creating a provision because I know in the future I'm expected to pay. On acquisition date already, I've got an obligation. I know for a fact that at the end of this period, at the end of the useful life of the asset, I'm going to have a dismantling cost. I'm going to have a site restoration or rehabilitation cost. I've determined what the present value is. I've determined it to be 25,000. So here you can just see I'm recognizing my actual payment that I'm making, which is the cost of the asset was 100,000. I've determined I'm going to have a obligation in the future, so my provision is 25,000. And here you can also see how we recognize it on the debit side. So the 100,000 goes to the cost of my machinery, and I've got another cost. So you can see both of them are costs. Both of them are costs, and they both, like we said, we are dealing with the price of the asset, the initial cost of the asset. So these are both part of the initial cost of the asset. We're just showing in our journals, we're just showing them differently. This is for the actual machine, and then we've got future dismantling cost of 25,000 Rand. So that is then the future dismantling costs, and we've now dealt with everything related to the initial recognition of my PPE asset. I'm just going to have a quick look to see if we've got any questions. Let me just see quickly. Okay. Okay, there was someone asking, can I give an example of direct and indirect probable inflow of economic benefits? I think I did. The question was maybe asked. The question was asked before I gave that example, but I think I did. That's where I explained that direct inflow of economic benefits is where we know this is going to affect. So I'm buying a machine. This machine will be used to produce my shoes. I'm going to sell my shoes. So there's a direct link between the machine that I'm buying and then the revenue that I'm going to collect at a later date. And then indirect probable inflow of economic benefits is I might be buying a newer machine with a quicker production time, and it might lead to better efficiency within my production process. So although it might not directly lead to revenue, it will lead to a reduction in cost. It can lead to a reduction in time wastage, can lead to a reduction in labor, it can lead to a reduction in the downtime, any of that, and then that leads to cost savings. So indirectly, it leads to an inflow of economic benefits. So I think I did explain that. Yes, the class is recorded and it will be uploaded at some stage, at a later stage. Can you give an example of how to enter the transaction in the financial statements? I will have a look at financial statements at the end of the class, what your financial statements should look like. So what you just need to remember is what is all affected. So if I've got PPE, I'm going to recognize it. It is probable, like we've said now, it's possible that we can have interest. If there is a abnormal credit terms, I've got interest, so the interest must be disclosed in my statement of profit and loss. Then you need to go to IAS 18. What does IAS 18 say? What does my statement of profit and loss look like? Where should I recognize interest there? You need to know interest is recognized in my profit before tax note. What does the statement say? What should be included in my profit before tax note? Then obviously my PPE, what is affected. If I then go to depreciation, once again depreciation, it goes to the statement of profit and loss. What does my statement of profit and loss look like? It goes to the profit before tax note, and then depreciation, how is it disclosed in my PPE note? It must be, if it's accumulated depreciation, what should it look like? If it's current year depreciation, what should it look like? But we will have a quick look at the PPE note later on. Yes, I have already said that we will record the class. Okay, so those are the questions for now. Let's continue. I will try to, I don't want to go too fast so that you miss something, but I will try that we go a little bit quicker so that we can finish off at 11 o'clock. Okay, then the next thing, so we've now dealt with recognition, we've dealt with initial measurement, now we need to deal with subsequent costs. So I've recognized my asset initially. I've recognized the asset initially, but then after that, I incur some additional costs. Can I now go and capitalize that to the cost of the asset, or must I expense it? Then, first of all, very important, we always go back to the recognition criteria first of all. Does it meet the recognition criteria? What's the recognition criteria? Does it meet that? Does it meet the definition of an asset? And then is the inflow of economic benefits, and can it be measured? Okay, so once again, always measure according to that. Then there are three major things that IAS 16 looks at. It looks at day-to-day servicing costs. It looks at what happens if I need to replace a part of an asset during the life of the asset. And then what if I need to do major inspections in order for this asset to work? So there is a difference between day-to-day servicing costs to just service. Those costs, IAS 16 says, is expensed to the statement of profit and loss. Those you do not put as part of the cost of the assets. You will not capitalize those. Replacement of parts. So I've got I'm going to use an example later on. I think I used the example of a fire truck. So I've got a fire truck. It's got the body, and just for then we say, but the engine is separate. So the body's got a useful life of, let's say, 15 years, but the engine must be replaced at a certain point. So then we can say, but the engine can only work for 10,000 kilometers. After it has traveled 10,000 kilometers, the engine needs to be replaced. How do we treat that? We de-recognize the old engine, capitalize the new engine, and then we will continue with that. If there's a different useful life to the rest of the asset, we will recognize that and depreciate as separate assets. When I get to depreciation, I will do this example for you. I just want you to now be aware of these different subsequent costs. We will look at the measurement and the depreciation calculations after we've dealt with depreciation. So there's day-to-day servicing costs, we expense those. It's possible that my asset does have different parts with different useful lives that must be replaced as we use the asset. How do we deal with those? Old parts, like an asset, we de-recognize whatever we don't use. If there's an addition of a new part, we will treat that as an addition, and then it's possible that those will have different useful lives. So that means when we do the depreciation calculation, we must have a look at them separately. And then the third one we have is major inspections. So even when you purchase this asset, they say, yes, you need to do day-to-day servicing, check the asset, do maintenance on it. that will be expense. But then you need to do a major inspection or major service, let's say every 3 years, or every 10,000 kilometers, or every 15,000 hours, depending on what the useful life of the asset is. So it's possible that they say to you to insure. So if we look at the lift, so if we look, we have a lift, but the company says to us, we can guarantee the working of the lift, but then you need to, every 5 years or every 100 hours that this lift has moved up and down, you will have to do a major inspection on certain parts of this. How do we treat that? We might have an obligation. How do we treat that obligation? How is it then depreciated? How do we treat those costs? We will also have a look at that when we look at depreciation later on. So just keep in mind, these are the possible subsequent costs, but we will look at some examples of them after we've done depreciation. So that is then our initial cost. Now we look at subsequent measurement. Today we're only going to look at the cost model, the revaluation model. It's not that it is not important or not relevant. The revaluation model is actually very easy because we only deal with revaluations on land. So revaluations on non-depreciable assets, which is actually very easy. You compare a fair value given to you at the end of a period with the carrying amount or with the cost to determine what your revaluation surplus will be. It is discussed in your study guide. It is actually very easy. I'm not going to deal with that today. So subsequent measurement, we're only going to look at the cost model today. So what does IAS 16 say regarding subsequent measurement? So it says to us that at the end of the period, so I have a list of assets that I've got in my financial records. I need to now show the value of these assets at the end of the period to the users of my financial statements. The company determines whether they use cost model or whether they use revaluation model. So in this case, the company we have has determined that for their PPE items, they will use the cost model. So what does IAS 16 say? At the end of the year, how must I show the value of my assets to the user of my financial statements? It says I must show this at the carrying amount of my assets. So I can have land, I can have buildings, I can have machinery, I can have vehicles, I can have equipment, all of those at the end of the period. What is the value of my buildings? I show it at the carrying amount of my buildings. How do I determine that carrying amount? Carrying amount will be the cost. So we have already dealt with the cost aspect of it. So we have calculated our costs. It says then we deduct any accumulated depreciation. So accumulated depreciation is depreciation that I've calculated since this asset was available for use up until the end of my current financial year. So that's my accumulated depreciation. And then, like I said earlier, we can have impairment losses. We do not deal with them currently on second year. They are dealt with by third year modules. So just be aware, my carrying amount is calculated as cost. Mine is accumulated depreciation. That is where we stop. But then on third year, you will also then learn about accumulated impairment losses. So just be aware of that third one as well. So how do I calculate depreciation? Sorry, guys, I just want to... No, IAS 16 is not new. Sorry, this was a question on Telegram. IAS 16 is not new. It's always been there. It is a very, very old standard that has always been there. I think you've known it, but I think it's possible that no one has just never referred to it. But everything that we've always done, even on first year, everything that you are taught on PPE is based on the IAS 16 standard. Okay, so that is just where that is coming from. So what is depreciation? This you've done on first year. I'm not going to go in detail on depreciation because, like I said, there are videos online already on the module uploaded, and I think there is one on depreciation as well. So I'm just going to go through depreciation very quickly. What is depreciation? It is the expense of the depreciable amount over the asset's useful life using the method that reflects the pattern that we expect to use it. So obviously the value of our asset, as it gets older and as we use it, the value decreases. We say, I've bought a machine. I say on initial, when I do the initial acquisition, I determine I'm going to use this asset for 10 years. At the end of 10 years, I'm going to say the useful life of the asset is now over. I've determined that there is a residual value. So I say at the end of this 10 years, I can maybe sell this asset for 10,000 Rand. So now I have a cost of, let's say, 100,000 in my financial records, but I need to now show the users of my financial statements over the period as I use it. I need to do something so that at the end of my 10 years, I just sit with whatever I determine the residual value to be. And we do this by calculating and recognizing depreciation every year. How do I do that? The company will then determine how do we expect the like you see there, the pattern in which we expect to use the asset. Is it going to be over a straight line period of 10 years? Is it a diminishing balance? Is it units of production? So can I say I expect the pattern of hours? So if I've got an aeroplane, I'm a airline company, so I've got airplanes, and I say that the useful life of my my airplane will be determined by the amount of flight hours we have. Then we have a units of production method. Or do we say I'm just going to use straight 20 years, then I've got a straight line method? Or will we say I've got a diminishing balance method, so that I say every year over the next couple of years, it will reduce by 20% per year. So the company determines what is the pattern, and the company will determine what method they will use. And then how do I calculate? Depreciation is calculated based on what? My depreciable amount. What is a depreciable amount? It is the cost that we've already determined in initial cost minus any residual value. What is residual value? I've touched on this quickly earlier. We say that we estimate at the end of the useful life of this asset, it is possible that we can sell this asset for a certain amount. We can make that estimate initially. It is possible that it can change later on. Those will be changed in estimates, which you will deal with in third year again. But we make an estimate at acquisition to say, we think the asset will have a residual value. This is what we think the residual value will be, or we think it's going to have no residual value. Just remember, depreciation is calculated on the depreciable amount. What is depreciable amount? Cost minus residual value. Okay. Like I said earlier, when we talked about the replacement of parts, it is possible for your asset to have different useful lives, so different parts. So like I said, we might have a fire truck. The fire truck has a body, it's got an engine. It might have, I don't know, if they determine that the hose or the machine that needs to spray the water might have a different useful life. It can be based on kilometers traveled. It can be based on years. It can be based on the amount of liters of water that it's sprayed. It's possible for one asset to have different parts that all have different useful lives, and then also different depreciation methods. So it is possible for, if we look at an airplane as well, the airplane might also have the outer body that we can say, okay, useful life 20 years. Then we can say, but the seats of the asset is only 5 years. So every 5 years we need to replace the seats. Then we can say, okay, but the engines of the airplane can only have 5 million flight hours, for instance. So it's possible for one asset to also use a straight line method together with the units of production method, and then we need to know how do we deal with the depreciation of that specific asset. But we will look at that in an example later on. So just quickly, different depreciation methods, I have touched on them. I'm just giving you the formulas here. But like I said, I think there is a video uploaded on the 2601 module site already dealing with depreciation. So I'm not going to go into detail on the different depreciation methods. Just know there are differences, and then you need to know how to calculate. First of all, how to identify, but the questions normally are very clear cut to say, company uses, depreciation will be calculated over 10 years on the straight line method, or 20% on the diminishing balance method. So what's the formula if I need to calculate depreciation based on the straight line method? Like we said, it's depreciable amount, so it's cost minus residual value divided by my useful life. And then important, we also have to look at the period the asset was in use for. So if we just quickly have a look at the straight line method. So if I'm calculating for my current year and it was in use for 12 months, it's easy. I will say 12 over 12 and I will have my my depreciation calculation. But if this is the first year that I'm using this asset, and we will have a look at the next example we're going to do will be like this. It's possible that I purchase an asset during the year. So I don't necessarily have it for 12 months of the year. I've purchased it during the year. Then I need to determine when was this asset available. Remember, depreciation starts on the date the asset is available for use. So it's not necessarily when it is actually started, when we start using it, it's when it is available for use. So I then have a look at when was the asset available for use, and I calculate the amount of months until the end of my financial year to determine that period. So it's possible that I only used it for 6 of the 12 months. So I will have my cost minus my residual value divided by my total useful life given to me in the question, and then I just need to check if I'm busy with my current financial year, when was the asset available for use up until the end of which date? If I'm busy calculating accumulated depreciation, the same principle applies, but it's possible that this can now be over a 3 or 4 year period. So remember, accumulated depreciation will be from the date that my asset is available for use up until the beginning of my current financial year. So if my year is from 1 January to 31 December, I need to have a look at when was this asset available for use. So we are now in the 2025 financial year. So the beginning of my current financial year would be 1 January 2025. So that means my prior financial year ended 31 December 2024. So to calculate accumulated depreciation, I will have a look at when was the asset available for use. And it is possible that I purchased this asset on the 6th of June in 2022 already. And then I have to look, when was the asset available for use? Oh, okay, it was available 1st of July 2022. Then I need to calculate my period from 1 July 2022 up until 31 December 2024. And that will be my period that I'm going to use for my accumulated depreciation. Remember, at the beginning of the year, I need to show my accumulated depreciation. I need to show my current year depreciation separately, and then I need to show a accumulated depreciation at the end of the year. So just remember always to have a look at the periods that your asset was available for use, and think about what you are busy with. Am I busy with current year depreciation, or am I busy with accumulated depreciation? And then just remember to check your dates. Go and write to yourself, oh, it was available 1st June 2022. My financial year was ending 31 December 2024. Calculate the amount of months for that period, and that would be relevant to your accumulated depreciation. Now, when we get to diminishing balance method, there's different ways it can be given to you. Your depreciation expense is calculated as your carrying amount minus your depreciation rate. So your question can say to you, your depreciation rate is 15% or 20%, for example. But the question can also say to you that the company uses the diminishing balance method over a 20-year period. Then you do not have the depreciation rate. Then you first need to go and calculate your depreciation rate, because you need to have the percentage in order to calculate your depreciation. How do I calculate the depreciation? I've included the formula here for you. I just want to say this is a divide sign. It is not a it's not a minus, it is a divide. So I've got 1 minus, and then in Afrikaans we call this the vierkantswortel. So I can for the life of me not remember what the English word is, but when you did maths at school, you would have studied that. So that is a vierkantswortel, and within that, you've got your residual value divided by my cost price. So you determine that value, and then you put that in your vierkantswortel, and that n is then your period. So if the question says to you the asset's got a useful life of 20 years, that n will be 20. If it says 15 years, the n will be 15. So just make sure that you can do this. Once again, it's just a formula. So just know it's 1 minus, and then within that vierkantswortel, we determine the value of residual value divided by my cost price. I get that, and do the vierkantswortel with the period, whatever is given to you in the question. This is only if you are not given your depreciation rate. If you are given the depreciation rate, the question will tell you we use the diminishing balance at 20% per year or 15% per year. Then if that percentage is given, you do not have to go and calculate this. It's only if this is not given to you that you first need to calculate your depreciation rate before you can calculate your depreciation expense for the year. The third method we have is the units of production method. That is an example if they tell us that I've got, if we go back to the fire truck again, I've got a fire truck. My engine is estimated to be able to work for a total of 10,000 kilometers. Then it will say to you that during this period, it traveled a total of 4,000 kilometers, and you can calculate your accumulated or current year depreciation using the information given to you. What's very important to remember when we work with units of production method, and this is an error that students make, and we have seen it in third year, we've seen it in CTA, students still make that mistake. When I use the units of production method, I do not go and put in there times 6/12 again. So if I have this asset for a shorter period, so it was available for use for less than the full 12 months of the year, I'm not going to allocate or proportion it for the period like we did there when we did the straight line method. Because remember that if I buy an asset during the year, automatically that will be seen in my actual output. So if I buy a machine, I buy two of the exact same machines. One machine I bought on the 1st of January and one machine I bought on the 1st of October. And I say I'm going to calculate depreciation based on the units of production method. Do you understand that if I say that the first machine that I bought in January, it was possible that this thing worked for 120,000 hours, but the one that I bought on the 1st of October could only manage to work for 30,000 hours. So that if we then say we calculate depreciation based on the total hours worked, has now already been taken into account to in my actual output. So therefore we say you do not go and have to proportion or account for it again in determining the number of months that the asset was available for use. So it is actually very easy to calculate units of production. All of the information should be given to you in the question. Just remember, do not go and proportion also based on the number of months that the asset was available for use, because it will already be taken into account in your actual output. Okay, so how do I calculate the units of production? I once again take my depreciable amount. What is the depreciable amount? Is my cost minus my residual value. I divide my depreciable amount by the total estimated output. So that if it says to me, the machine can run for a total of 100,000 hours over its useful life, then my total estimated output is that 100,000 hours multiplied with the actual output in the period. So like I said, here we had 30,000 hours. So that 30,000 is the actual output for the period. And that is my 3 depreciation methods. We will now quickly look at some examples of how to calculate depreciation. Remember, I said when we have to do replacement parts and when we have the major inspection, we will look at some examples after we've dealt with depreciation. So we will now look at 2 of those examples on how to calculate the depreciation in this case. So if we look at our first example, this is the one where I kept referring to the fire truck. So this is one where we've got an asset, in this case a fire truck. It's got different components. So the question says to us, it says on the 1st of February 2024, we purchased a fire truck at a cost of 100,000 Rand. I know this is not, it does not seem real, it's just for an example. So the body of the truck has useful life of 15 years, so that's one part of my asset, while the engine has an estimated useful life of 10,000 kilometers. So after 10,000 kilometers, if the 10,000 kilometers happens before the 15 years are up, that means I have to then de-recognize the old engine and I will have to buy a new engine and recognize that new engine. The cost of the engine already included in the cost of the truck amounted to 25,000 Rand. So what does this say? We said that the total cost of the truck is 100,000 Rand. The engine costs 25,000. That is already included in that 100,000. So I don't have to go and add a cost over and above 100,000. The 25,000 is already included in the 100,000. And then it says the fire truck traveled a total of 1,750 kilometers during the year. The company has a 31 December year end. So what do we need to do? We need to calculate the depreciation on the fire truck for the year. So let's have a look. So we purchased this on the 1st of February 2024 was our purchase date. The end of our financial year is 31 December 2024. We need to calculate depreciation for this period. What is important to keep in mind? We have both a body and an engine, and they've got different useful lives. So we must calculate the depreciation for this asset separately. So let's quickly go and have a look at this calculation. So like I said, please just excuse my handwriting. I'm trying my best with writing while giving class. So we will have a total, we will have a calculation for the body, and we will have a calculation for the engine. We must do these separately, and then we will disclose the total. So we will disclose one figure. That's very important to remember. So for calculation purposes, we split this asset because the asset has parts that have different useful lives. But we will only disclose in our PPE notes, we will only disclose the total column. So please keep that in mind when we do disclosures. So we said that the cost of this asset is on the 1st of February, 1 February 2024, we purchased this, so this at our acquisition date. The total cost was 100,000 Rand. Remember, the question said that 25,000 was already included in the cost. So that means that the cost of my engine was 25,000. That leaves 75,000 for the body of my engine. So once again, just to double check, how do I get the 75? The question said the total cost of the fire truck was 100,000. The cost of the engine was 25,000, but that cost was already included in the cost of my truck. So that leaves 75,000 for the rest of the engine. So if you can just make a note again quickly, I just want to write above here. So the question says this has a useful life of 15 years and this has a useful life of 10,000 kilometers. So it's for this reason that we are now splitting the depreciation, because we won't be able to calculate the depreciation just based on the 100,000, because it is split in 2 different parts, and the 2 different parts has got different useful lives. So how will I then calculate the depreciation for this asset? The first one we will look at is the body. So how do I calculate the body? So remember, we said depreciation is calculated based on the depreciable amount. What's the depreciable amount? It's cost minus residual value. We're not given a residual value in this question, so my depreciable amount is the 75,000 Rand. We said we divide by the total estimated useful life, which is 15 years. And then I said, remember, if an asset was purchased during the year, remember that we need to take a look at when was the asset available for use. In this case, it's available for use on the 1st of February, and our financial year is up until 31 December. So that means that that asset was available for use for 11 of the 12 months. That would give me depreciation of 4,583 Rand for the body of my fire truck. If we have a look at the engine's depreciation is calculated based on kilometers traveled. So once again, we take the depreciable amount, which is 25,000, my apologies. It is told to us the cost of the engine was 25,000. There's no residual value. The question said that the total useful life is 10,000 kilometers. So that engine can travel a total of 10,000 kilometers. And then what did we travel for the year? The question said the truck traveled a total of 1,750 kilometers. So just a reminder again, can you see that I'm not going to go and say 11 times or 11 over 12 year? That the fact that we're using it only for 11 months is actually already indicated in the number of kilometers traveled, because if you use it for longer, then it would have traveled more kilometers. So that gives me then 4,375 Rand depreciation on the engine of the fire truck. Then I add these two together, and then I get 8,958 Rand, which will be my depreciation for the year. And once again, this will be the column that I'm going to disclose in my PPE note. So how will this be disclosed? This was actually, so our financial year is 1 January 2024 to 31 December 2024. So that means that this fire truck was actually purchased during the current financial year. Because it was purchased during the current year, I would need to disclose this as an addition. So under my vehicles or under my trucks column, I will then have an additions line item, additions 100,000 Rand, and I will have a line item depreciation, and there we will disclose 8,958 Rand. So we will not have a body column with 4,583 Rand and an engine column with 4,375 Rand. We will only have one column for the truck, and that will have a total depreciation of 8,958 Rand. So that is our example of significant components, which I've now also showed you how to calculate your depreciation. Let's look at major inspections. Major inspections works on the same principle as a significant part. We need to keep in mind that, remember we said previously, if there is a requirement, when we looked at the lift, if there's a requirement that our lift must be inspections or must undergo a major inspection every 3 years or every number of hours that it's worked, doesn't matter the useful life, but there is a requirement that we must undergo a major inspection. That means that we will from the start have to already account for that major inspection in the way we recognize depreciation. So if we look at this example, it says to us, that we've purchased a cargo ship on 1 January 2024 at a cost of 2.5 million Rand. The ship has a residual value of 300,000 Rand and an estimated useful life of the ship is 15 years. So I've got the cost, I've got the residual value, I've got the useful life, but then it says to me, in order for the ship to perform optimally, it must be inspected every 3 years. So now I've got this additional requirement that every three years someone must inspect, and then if there is some sorry, my words are running out. So it must be inspected, and then if there's a service, if it needs to be serviced, every 3 years. The first inspection is expected to take place on 31 December 2026. So here you can see 3 years after the date of purchase at a cost of 180,000 Rand. So once again, just remember at this stage, we have not actually incurred the cost of the 180,000, but there is an obligation in future. We will have to incur the cost. At this stage, it is only an estimate of what it will be. We don't know what the cost will be exactly. We only know that in the future, we are going to have to perform an inspection on this cost, on the ship, and then we estimate it will be 180,000. So now IAS 16 says in the way we depreciate this asset, we will have to take this into account. So a portion of the cost of my asset, I will have to depreciate over the 3-year useful life and not over the 15 years like the rest of the asset. At this stage, it's only an estimate. We're going to work with 180,000. On the day that we actually do an inspection, we will recognize that as an addition, and then we will use that cost going forward to calculate the depreciation on the inspection component. There was a question, sorry, if we go back to the 15 years, the body of the truck, the question said specifically to us that the truck has a useful life of 15 years. That's why we use 15 years for the calculation, to calculate depreciation on the body of the truck. Okay, if we continue on with this example, let's have a look then at what my calculation would look like. So as we had with the fire truck, we're also going to calculate them separately. Ooh. Sorry, just trying to get my lines here correct. So we will have the total. We will have calculations for the ship. And then we will have calculations for the inspection cost. Once again, apologies for my handwriting. It's not very easy to try to write while giving class. Okay, so we've got the cost here. The cost was, the total was 2.5 million that was given to us. So remember I said at this stage we only have an estimate, and this estimate will only be used to calculate the depreciation for this major inspection that will take place in the future. This is not a separate asset yet. We have not recognized or capitalized this cost. This is just an estimate of what we have already paid. So we have said we've paid 2.5 million for the cost of the asset. 180,000 of that we estimate. That's what we think we're going to pay in future. We estimate that we're going to have an inspection cost of 180,000. So the remainder, 2,320,000, is then for the cost of my ship. Remember, this is just in order to calculate depreciation, because we need to show that a portion of the cost price, the useful life or the value will reduce quicker than the rest. So for the 2,320,000, that value will reduce over the 15-year period, but the 180,000 will be reduced over 3 years, and that we need to show to the users of our financial statements. So if we look at the depreciation, the first one for the ship, remember depreciation is calculated on depreciable amount. Depreciable amount is my cost, so that's 2,320,000. Then the question also said to us there's a residual value. So remember to deduct your residual value. Residual value was 300,000. It said to me that I've got a useful life of 15 years. So if we look at, in this case, we bought the ship on 1 January 2024. Our financial year ends 31 December 2024. So it was used for 12 months. So I can just say 12 over 12, or I can just leave it, because that is in any case the same. It's not going to make a difference to the answer. I do not have to apportion or proportion, because it was used for the full 12 months of the year. So remember, depreciable amount, I need to deduct my residual value. If I do that calculation, the depreciation for the ship is 134,667. And then if we look at the depreciation for the inspection cost, it is 180,000. There's no residual value for the inspection cost. And we said it will have to be done every 3 years. So I take the 180, divide by 3. Once again, the asset was used for the full 12 months. So I can say 12 over 12, or I can just leave it because there is no apportionment. It was for the full 12 months. And that gives me depreciation on the inspection component of 60,000. And then if I add these two together, that gives me my total depreciation on this asset is 194,667 Rand. Once again, this will be the column that I'm going to disclose in my financial statements. So I purchased this during the year. I will have a ship, or I don't know exactly what, it will be. Let's say you will have a column for ship, then you will have opening balance. There won't be anything because this asset was not available at the beginning of the year. We only purchased it during the current financial year. Even though it was on day 1 of my current financial year, it happened during my current financial year. So I will have an additions line item with an amount of 2.5 million. We'll have an amount of 2.5 million. That will be my addition. And then I will have a depreciation line item of 194,667. So those will be the values that we will disclose. Then if we then get to our period, so this question said that on 31 December 2026, we will do the actual inspection, and then we will have an actual price. So if we are in, so obviously we've now for 2024, we've recognized 60,000 of the depreciation of the 180. We did it in 2025, we've recognized another 60,000 depreciation. We get to the 2026 financial year. The inspection takes place on 31 December 2026. So we have obviously recognized depreciation, another 60,000, because remember, it's now our full year period. So we've now recognized a total of 180,000 depreciation for this inspection component. So what are we left with? We are left with, if I just erase all of this, give me some writing space. So I just want to show you that when we get to the 2026 year, what will we do? Okay, we've got some space again. So we then get to 2026. So we will have then, so the cost was originally 180,000 that we estimated for this inspection cost. So we recognized a total accumulated depreciation at the end of 2026, 180,000. So remember, for anything the day we don't use an asset anymore, we need to de-recognize. That is actually what we'll discuss in our next slide. At what value do we de-recognize? We de-recognize the remaining carrying amount on the de-recognition date. In this case, it is 31 December 2026. Remember, we are now in 2026. But because we have the full 3 years has gone past before we've done the actual inspection, we have recognized all of the depreciation on this asset. So we have no carrying amount. So we will de-recognize a value of 0. But now we're saying, okay, but I'm doing the actual inspection now. The actual inspection was then 210,000 Rand for instance. So in 2026, I will then have a line item, additions 210,000 Rand. And then from there on, for the next 3 years, I will calculate depreciation on inspection component based on this 210,000. Then I will continue for the next 3 years, recognize depreciation based on the 210,000 until I do an actual inspection again, where we will get the new value, whatever the inspection cost was, and then we will continue from there onwards. So you will use your estimate originally because you don't know yet and you've not actually done an inspection yet. So initially you will work on an estimate until you do your actual inspection. And remember, it is possible that the actual inspection can take place earlier. So if we have a look at this, so let's just say that the actual inspection took place at the end of 2025. So for some reason, it was necessary for us to do the inspection earlier than we anticipated. Originally, we said after every 3 years. It is possible that something happened and there was damage on the ship, and we had to do an inspection earlier. So now let's say we're doing the inspection at the end of 2025. That means that I would have accounted for 120,000 depreciation. So remember, there was 60,000 in 2024 and another 60,000 in 2025. So in total, I recognize 120,000 accumulated depreciation, meaning that on the date that I did the actual inspection, there was 60,000 of that original estimate left. So that means that I will have to go and de-recognize. So if my inspection takes place earlier than expected, that would mean that I'm still going to have a carrying amount of that inspection component left. So you just need to remember that the portion of the carrying amount that is left, you must de-recognize, and then you can add as an addition the actual inspection or the new inspection cost. So I will de-recognize the 60,000, have an addition for my 210,000, and then from there onwards, I will calculate my depreciation. If they still say every 3 years, I will then calculate depreciation based on for the inspection component over 3 years. 210,000 over 3 years. Continue with that up until the date that my actual inspection takes place, and I start this cycle all over again. So I hope this makes sense to you. If you've got questions, you can post them in the Q&A and I will have a look at them later. We are almost done. We just need to have a look at derecognition and then quickly at our disclosure, presentation and disclosure. So derecognition, I'm not sure if you've dealt with this in first year already, but throughout the class we did touch on this a little bit. But so when I don't use an asset anymore, so when I sell it, when I dispose of it, when I can get no future economic benefits from it anymore. So it is possible that for some reason, before the end of the useful life of this asset, if I've got a vehicle, it is possible that the vehicle was written off in an accident. So I determined initially that the vehicle has a useful life of 10 years. After 3 years, I was in a major accident with the vehicle. The vehicle was completely written off. So there is a carrying amount left. I have to take out this asset from my financial records. I can't show an asset in my financial records that I've got that I can get no economic benefits from anymore. It's also possible that I have this vehicle, but I decide to sell it before the useful life of the vehicle is up. Also meaning I've got a carrying amount left. I have to take out that carrying amount. I have to take out the asset from my financial records. So when I can no longer dispose when I dispose of an asset, so when I sell it, or when I've got no future economic benefits from the use of that asset anymore, I must remove all related accounts. Please remember, what are the related accounts? When we're dealing with an asset, initially you recognize. So think about when you did your journals. So what are the related accounts? When I initially recognized this asset, if it was machinery, I would have had machinery at a value. I would have had bank, okay, we've paid for that. Okay, then as the years went on, I recognized depreciation, which goes to profit and loss. And then I would have also recognized accumulated depreciation, which would be in my statement of financial position. So what are the relevant accounts for this machine? I recognized initially I debited a machinery account, and throughout the years in my statement of financial position, I recognized depreciation on this asset every year. So remember, this one goes to profit and loss. So it starts over, it resets every year. But the ones that are in statement of financial position, they continue with their balances throughout the period. So on the date that I dispose of, or when I can no longer get any economic benefits from this asset, I need to de-recognize the asset from my financial records, meaning I have to clear out all of the accounts that are relevant to them. So I need to take out the machinery and I need to take out accumulated depreciation. When we get to third year, if you've got accumulated impairments or reversals of impairments, you also have to clear out those accounts. So just remember, what is derecognition? I cannot use this asset anymore. I sold it, I disposed of it. The building burned down, the vehicle was written off in an accident, whatever the reason was in the scenario, that asset must be removed from my financial records. I can't simply go and say I'm going to credit machinery with the balance of the carrying amount. I need to take out these different accounts separately. So what will the journal look like? There I'm just reversing. So remember, whatever we did initially, we now have to reverse. So like we saw here, I initially debited my machinery account. So that means now in this case, I need to credit. So this is now my machinery. I credit my machinery account with the original cost that I calculated at initial recognition for this asset. Like I said, when we did our depreciation throughout the periods, at the end of every year, I credited my accumulated depreciation in the statement of financial position. So that means that now I debit my accumulated depreciation with the total amount that I've recognized as depreciation on this specific asset throughout the period. So remember, the difference between these two will then give me a carrying amount on the date of disposal. The other account that's relevant, if I sell this asset, it is possible that I will get money. So what do? If I get money, I debit my bank account with whatever I get. So if I sell this machinery, I get 100,000 for it. I will debit my bank with 100,000 Rand because that is the cash that I'm getting for this. If this asset is written off and the insurance gives me some money, then obviously there will be something. If the asset was not insured and I do not get any money, then my bank value will be zero. Then the net effect between this transaction. So I've debited accumulated depreciation, I've credited my cost, that gave me a carrying amount. So the difference between the carrying amount and whatever I get for this transaction. So if I sold it, I will get some money. It's possible that the insurance can pay out and I will get some money. The difference between that, so the balancing figure will be either a profit or a loss on the disposal of the asset. So it just depends on what happens between these three. It is possible that I will then have a profit or I can have a loss on the disposal of the asset. So these were the journals. And then if we look at disclosure, what will happen? I will just have one line item in my PPE. So I have my machinery column, and then I will have a line item, derecognition, and there I will only disclose the remaining carrying amount. So if whatever that carrying amount was that I calculated, that I will disclose as a separate line item in my PPE note. So that is it for derecognition. If we then look at disclosure, I touched on this quickly a little bit earlier. Just remember, it is possible that we can give you a list of transactions. So we can give you 5 or 6 different assets. It's possible that there can be abnormal credit terms. It's possible that there can be future dismantling costs. You just need to remember whatever is relevant and how it fits into all of the other notes. Because most of the time, students get the PPE note correctly. But for instance, we will then ask a profit before tax note, and students forget there. So they will include one or two of the depreciations, but students then forget that, oh, but there were abnormal credit terms. Abnormal credit terms has an interest expense that must go into my profit before tax note. So just remember where everything fits in as you go through your transactions. The same with depreciation. Oh, depreciation, I said this earlier, it goes to my statement of profit and loss, but it also goes in a profit before tax note. So make sure that if you are asked a profit before tax note, what goes into it? All of your material income and expenses must be listed. And remember, there's a difference between a profit before tax note and your statement of profit and loss. Statement of profit and loss is the one revenue, cost of sales. That is your IAS 18 presentation. But then you get a profit before tax note, which is a note. It is not your statement. It's an additional note to your financials. Like your PPE note is an additional note further explaining what happened. The profit before tax note is also a separate note. So make sure you know what should be in there, what it should look like. I should have income, list all of my material income there. I should have expenses, list all of my material expenses there. And then just remember, as you work through a scenario, that you find a way to include, because that is what happens a lot of the time. And unfortunately, in marking, and especially when disclosure is asked, we are very, very strict on marking. If you did not answer the required, we cannot award you marks for what you did. A lot of the times, and we see that especially with the profit before tax note, a student will have all of the calculations correctly, but they've not transferred that to the correct or the relevant notes. Then, because you did not answer what was required, I cannot give you marks for your calculations. Yes, you've got an aspect or a part of the question correctly, but remember, what is the aim here? We need to prepare financial statements. Your investors or creditors, whoever uses your financial statements, will see your financial statements. They won't see your calculations. So if you've calculated something, but it's not disclosed in your financial statements, the user of the financial statements does not see that information. So it's very, very important. Answer what was required. Ensure that if you've calculated something, that it is transferred to the relevant notes. Answer what was required. If a discussion question was asked, make sure that you discuss. If a question says discuss supported with relevant calculations, you cannot just simply give us calculations, because it was first asked to discuss, and you should only support whatever you discussed with calculations. If you only provide calculations, you have not answered what was required. So make sure that you answer. If it says disclosure, make sure that the layout of the note is correct. First of all, it must be in accordance with the relevant IAS, so the relevant International Financial Reporting Standard or the relevant International Accounting Standard requirements. Make sure that the layout is correct, and then make sure that all of the relevant information is actually included in that note or in that statement or whatever is required. If it's a journal, make sure the amounts are in the journals. If it's PPE note, make sure everything is in the PPE note. If it's a profit before tax note, make sure it is in the note. Okay, then we just quickly look at an example of my disclosure. What does my PPE note look like? Important to see, we've got separate columns for each class of asset. But also note, it's possible that I can have 4 different types of equipment. So I can have 3 properties, but I will only have 1 column for land, 1 column for building, 1 column for equipment, 1 column for machinery. So even if I've got 10 machines in my operation, in my company, I will only have 1 machinery column. So there's 1 column for each class of asset. Do not go and do 10 or 12 different machinery columns for each one of the machines you have. 1 column for each class of asset. Then you will see your opening balance. You split between cost. So what was the cost of all of my equipment? And what was the accumulated depreciation for all of my equipment? Okay, once again, like I said, if you're asked to disclose, make sure that the amounts are in the notes. Because when we mark, I start from here. I see, okay, you've got accumulated depreciation, 297,284. Where can I get that figure? Then you need to show me in a calculation. So this is just some exam tips. Make sure that your referencing is very good, or that your calculations, I think I've said it in the first class as well, even if you say 1 + 1 = 2, the moment you change a figure from what was given to you in your question paper, you need to show us in a calculation how you got to that figure. So you've got now 297,284. You need to show me somewhere, but that was done by x plus y gave me that figure. And if x plus x, xx is also a calculation, you also need to show me how did I get to xx. I need to be able to follow exactly what you did. I need to be able to see your thought process, because it does happen. We all make mistakes. It's possible that you just used an incorrect period. It's possible you used the incorrect useful life. It's possible that you forgot to include a cost. All of the rest, there might be 5 different cost items that were relevant. You included 4 of the 5. If you show me a calculation, I can give you marks for the 4 that you had correct, and you will just lose the mark for that one that you had incorrectly. But if you don't show me a calculation, I cannot determine what you did. I cannot determine what were the correct principles or incorrect principles that you followed. There's nothing that I can do. So if you give me calculations, and the more calculations and the more detailed your calculations are, the better you are at, the better your chances are of getting marks, because then the marker can see what you did. Remember, we only used qualified CAs. You have to be a qualified CA in order to mark for us. So these are professional people. But you have to make it as easy as possible. When I was at university, they always said to us, an uninformed person should be able to look at your script and follow what you did. So even someone without any accounting background should be able to take your PPE note, for instance, and then say, okay, you've calculated 464,692. Where is that? Okay, I can see this is where you did that calculation, and then I can follow your steps or your thought process in your actual calculation to award you the marks that's necessary. So please remember, you have to include calculations. And first of all, it must be disclosed in the relevant note, or it must be used in answering what was required from the question. So if you were asked a PPE note, please make sure that the layout is correct. What is the layout? Like I said, you split between your cost and accumulated depreciation for carrying amount at the beginning of the year. Then this is all that happens during the year. So these are your reconciling items between my carrying amount at the beginning of the year, carrying amount at the end of the year. So actually what happened during the year? Oh, there were additions, there were depreciations. Oh, I had a revaluation on land. If there were any derecognitions, this is where my derecognition line item would come in to say, oh, and then the user can see, oh, okay, but you derecognized machinery to the value of 20,000, for instance. You derecognized. Then they can see everything that happened during the year. They can see there. And then you have your closing balance information. Once again, you split between cost or gross carrying amount. The moment there is a revaluation involved, we just call it gross carrying amount, and you've got your accumulated depreciation. And then a very easy thing that awards you some marks that majority of the students forget is the moment I've got an asset that is revalued and a revaluation has taken place, I need to provide that information in a narrative sentence. So yes, they can see there was a revaluation surplus of 55,000. Why was there a revaluation? Why was it? Who did it? Land was revalued on the 31st of December 2014 by an independent sworn appraiser, and then you have to tell them if it was cost. So if this asset was never revalued, if I used a cost model, what would the cost of that asset have been? What would the carrying amount have been? For land, it's easy because there's no depreciation, so that is then just your original cost. So just remember that if you have an asset that is revalued, include that narrative information. There is 1 or 2 easy marks there that you can obtain, and it is all just from rewriting information that is in your question paper already. And that is it for PPE, guys. Thank you so much for joining me. I see we just then went a little bit over time. I will quickly have a look at some of the questions and see if there are some that I can answer now. Otherwise, I will just do some typing back in the question. And then I see on Telegram there was just one. Can we use past exam papers to practice, or are they not for practice? You can just remember that they might be outdated, and there has been some changes in the way we are marking. We are trying to align better with third year, with CTA, with what SAICA is doing. So there are changes in the way that we are marking. There definitely are changes in the way the questions are asked. Like I said, you will definitely get discussion questions in your assessments. Those were not necessarily there in the past, but you are more than welcome to use past exam papers. Lecturers can just not go and tell you, okay, but this has changed since. So for instance, this year, IAS 18 is different for 2601 than it was last year. It's a new standard that came in, so obviously your past exam papers will not be updated with that new information. So it is very good practice to make use of old papers, but if there are changes, you just need to be aware then of what those changes were. Also, 2601 does have a tutorial letter with integrated questions that you can also use as practice for working through questions. You should definitely try to work through as much questions as possible. It is an excellent idea to work through questions, and that is how you test your knowledge. And if you listen to my class 1, I'm actually very passionate about this, and I will say it 100 million times. You will only get value out of working through past papers or other questions if you do it in the correct way. When I was at university, we call it the "yeah" method, "oh yes" method. When you sit with a question and you sit with the answer, it's got no value. You have to work through them under exam conditions. What does it mean? I stick to that time. If I've only got 50 minutes for that question, that is the time I will have. That is the time I will attempt it. If I am writing an exam, I should not have access to study materials. I should not have access to videos. I won't have access to a suggested solution. It is only me, and it's only that question paper that I have. So that is what I do. So what you do, take that question paper, you set a timer for yourself, you start writing. You attempt the question, you answer the question. The moment that your time is up, what you then do is you stop the timer, you stop writing. You can take a break, then you come back, and then you mark. Then you compare your attempt to whatever is in the suggested solution. First of all, you will see your time management. Is my time management okay, or should I actually be working on time management a little bit more? Okay, then you go on and then you have a look at what are the differences. Oh, they've calculated cost in this way. I did it another way. Oh, they did not include staff training fees. Why did they not include staff training fees? Then you think about it. Okay, but then you go back to what does IAS 16 say relating to staff training costs? Oh, it says it's never capitalized. But why did I capitalize it? Then you go and then you test your knowledge to say, okay, but where am I lacking? Where is it, oh, I just never knew about this, or I interpreted it wrong. I had the guideline or the rule wrong. And then you go, but if you still don't understand, if we did an inspection component depreciation, for instance, and you still can't figure out, but why did we do it in a certain way? Why did we de-recognize? Why did we use this value? Then you ask your lecturers, you say, I worked through this. This is how I understood it, but you did it in another way. What was your reasoning behind that? And then a lecturer can explain to you, oh, okay, it's also possible we make mistakes. So it might be possible that we made a mistake and we can say, oh, okay, no, but you are actually correct. This is what it should be. Or we can tell you, no, this might be where you are understanding you're lacking, or understanding is lacking. So this is actually what IAS 16 says, and this is why we treat it in a certain way. So then you learn from working through that paper. You need to get as much value out of working through past questions as you can. It honestly is going to be of no use to you if you just sit with a question paper and you sit with the answer, because a lot of the times the issue is with you knowing where to start in a paper. If you just look at the moment you get stuck, you immediately go to the answer. It's possible that once you know that this is an inspection component, you will know how to deal with the inspection component, but you are struggling to identify the inspection component in the question, for instance. Or once you know that it is actually units of production method, you know how to do the units of production calculation. But when you're reading through the question, you don't know how to identify, but okay, I'm actually dealing with units of production and I'm not dealing with straight line method. So it's possible that those are the issues. It's possible that, oh, you know it's a PPE, but you don't know why. Then you need to practice discussion questions to be able to answer that. So yeah, I'm very passionate about that, to say to you, you must get as much value out of it as possible. You need to really work through that in the correct manner to identify your gaps in knowledge, identify your gap in skills. Time management, I can tell you, is a big, big thing for all accounting students. We have increased the time now. We work on 2 minutes per mark. So your question paper, if it's 50 minutes or 50 marks, you've got 100 minutes. If it's 100 marks, you've got 200 minutes. We are very, very, very strict. If there are repeating students here, you will know this. We are very strict on sticking to the time given to you. We do not allow, we don't open up portals again. We do not extend time. The time you have is the time you have. So you really need to practice your time management skills when working through past papers. Let's go through some other questions. Why is inspection cost deducted before calculating depreciation? Remember that when we do the initial inspection, or when we do the initial recognition, and before we do an actual inspection, we only have an estimate. So we do not have an actual cost of an inspection that has actually been capitalized to the cost of the asset. Initially, we only make an estimate. And for that portion that is an estimate, we still need to show the users of the financial statements that there is a portion of this cost. So in our question, I think it was a total 2.5 million and 180,000. So we still need to show the users that a portion of that 2.5 million is written off or depreciated in the shortest period of time than the rest of the 2.5 million. So once we do the actual inspection, like I said later on, then we capitalize the cost and then it's a separate thing. But because initially we only have an estimate, it's not an actual cost that has been incurred yet. We need to just show the users of the financial statements that this is happening. So that is why we are deducting, because it was not actually incurred yet. The moment we do an actual inspection, we incur the cost, then it's going to be an addition, and then it's going to be a new separate cost. I hope you're happy with that. What about when we are given, let's say, depreciation of 20% on the straight line, then you will use your depreciable amount times 20%. Next year, depreciable amount times 20%. So the difference between straight line and depreciating balance is straight line, you are always going to use your depreciable amount, which is cost minus residual value, times 20%. If it's diminishing balance, initially it will be your depreciable amount times 20%. But then for the next year, now I'm going to use the carrying amount. So what's the carrying amount? It's going to be my cost minus the first year's depreciation times 20%. The year after that, it's going to be cost minus the first year depreciation minus second year depreciation times 20%. So if for straight line method, you are still given 20%, you're also going to use the 20%, but it's going to be cost minus residual value. So it will always be your depreciable amount times 20%. Whereas if we have diminishing balance, I'm going to use the carrying amount, which will be my cost minus all accumulated depreciations. Going to give me my carrying amount at the beginning of the year times 20%. I hope that answers your question. From overseas and paid 1st of 1 Jan, but then arrives on the 1st of April. How do we deal with that? That you will have to look at when does all of the risk and rewards transfer. That is normally when you do in your third year, you are going to do foreign exchange transactions. So there you're going to deal with exactly how you treat that. But your transaction or asset is recognized. So when you meet all of it, when all risk and rewards have transferred, ownership is transferred to you, then you can recognize your transaction. So if you buy from overseas, you've paid the first on the 1st of April or 1st of January, it only arrives on the 1st of April. It's possible that the portion that you've paid on the 1st of January might just be a deposit. So you will then depreciate or debit a deposit account, credit your bank account, and then when you actually can recognize the asset, you've met all of the recognition criteria, everything has been met. Now you can actually recognize the transaction. Then you will move that portion that you've paid on the 1st of January. You're going to credit the deposit account and then debit the actual asset. So if you bought a machinery, then on the 1st of April, you're going to debit your machinery, but then remove whatever you've paid that you recognized initially as a deposit. You're going to then on the 1st of April, move that and recognize an asset. But this is something that when you deal with foreign exchange transactions in your third year, that you're going to, you'll be learning that there. It's a PPE layer supposed to be in particular order. Is it okay if we don't have a set out order in the study unit as long as the categories are there? What is important is you need to have your categories. So you've got the order of categories. You can have land, you can have building, or you can have building, land. Those are not important. So you need to have separate columns for each. Then you need to have carrying amount at the beginning of the year. You need to have cost, which shows your opening balance cost. It shows your opening balance accumulated depreciation. The order of the line items, once again, is not. So you can have additions, depreciation, revaluation surplus, or derecognition, or you can have derecognition, revaluation. The order does not matter, but the layout of what it should look like should be there. So it should be different columns for each category. So one column for land, one column for building, one column for machinery. You should have opening balance split between cost and accumulated depreciation. Your reconciling line items, the order of the items doesn't matter. And then you should have, once again, for your closing balance, a split between cost and accumulated depreciation. So the layout of what it looks like is very important, but the order in which, so I'm not sure if that is your question, if the order in which those reconciling line items, that's not set. Those can be in different orders. Importantly is your referencing. If I can see you've got an additions line item and you can refer me to the correct calculation or the correct asset, and I can see where you've calculated whatever you've disclosed there, that is what is important. Okay, so I hope I answered your question there. Thank you. This class helped. It makes application of the standard easier. I'm so happy to hear that it helped you. That is what we're really trying to aim for. Yes, there will be a recording. I think I've answered that. Can you kindly give an, okay, that I have answered. So I think I have answered all of the questions. Thank you so much for sticking through the entire class. And like I said in the past, please feel free to reach out to us if you've got any questions. We are more than happy to assist you. Please enjoy the rest of the long weekend. Enjoy the rest of the public holiday. And we will see you again. There won't be a class next week. This class was actually presented, instead of presenting a class next week, Mr. Alfred will be in contact with you to reschedule the class that was supposed to take place yesterday. He will reschedule with you, but yeah, please keep an eye out on your announcements and we will communicate the rest of the classes to you in the future. Good luck with your assignment this week and we look forward to be in contact with you in the future. Bye, guys.